Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. When you trade and get paid, trade and get paid, trade and get paid, trade and get paid, trade and get paid. Oh yeah, trade and get paid, trade and get paid.
All right, so now let's talk about lots and lot size and percentage-based risk, because honestly, of all of the things we're talking about today, this is probably one of the most important, because this is like your first step of risk management. Before you learn strategies, before you learn everything that YouTube is gonna teach you, I wanna encourage you right now. I want you to stop what you're doing, put down your paper, put down your pen, and I want you to focus on me right now, because I'm coming to you with as much passion as I possibly can. If you want to be successful, you have to learn risk management. That is the number one thing in Forex. Beyond anything else, we need risk management. I don't care how good of a strategy you have. If you don't understand risk management, you're going to lose your money. So you heard it here first. Fast forward, if you don't focus on risk management and you lose your money, don't come commenting below talking about how the strategy didn't work or this and that. What I want you to do is focus on risk management, okay? I know the YouTubers are telling you to focus on strategy. I'm telling you, focus on risk management. You can't make money if you don't know how to not lose money. All right, so now let's talk about lots. In Forex, what happened is before you really had like these brokers and micro lots and mini lots, you had to do full trading with a lot of money. You didn't have leveraged accounts. You didn't have, which we'll talk about leverage later. You didn't have mini and micro accounts. You know, you had just standard accounts where you had to purchase big lots and you couldn't, do any less, right? So essentially what a lot is this. There are units of currency, okay? And what happens is a standard lot equals 1,000 units of currency, okay? A mini lot is 100 units of currency, and a micro lot is 10 units, okay? So we have a standard lot, we have a mini lot, and we have a micro lot, okay? Most of you, especially in small accounts, are probably trading micro lots. If you're using MT4 and you're using like a standard broker, you're probably using a micro lot account, an ECN account. So again, I have another video that teaches you like which broker to choose and which, that's a whole nother video. But for this purpose, I just want to teach you what's happening with these trades, all right? So here's what's happening. You have your standard, your mini, and your micro lot. Now, why is that important? Because what really comes down to is, many people that trade today probably don't even understand this portion of it, but this portion, the lot size, that is where your risk management comes into play. So this is important because we're talking about lot size, okay? So let's check this out. Basically, brokers have to buy lots, okay? And then what they use is they use multiple retail traders to purchase lots, and you're trading by, let's say, micro lots. So when you're trading, okay, you have what's called lot size. And when you do that, what we're finding out essentially is what is each pip worth, okay? That's really, in a very basic sense, what we're kind of coming down to is how much is each pip worth. The next thing you need to understand is that every trade needs to have a determination of lot size. You can't, so many traders, what they'll say is, I'm just gonna trade with a 0.2 lot size and that's it. I'm just gonna use that no matter what. I've even heard people ask me, like, if I have $1,000 in an account, what should my lot size be? Well, that's not a fair question or a reasonable question, because just because you have a certain account size or margin size doesn't mean that you should use the same lot size in every trade. We're gonna talk about percentage-based risk next, but lot size is gonna be determined each trade individually, not for account size, all right? So when you're looking at lot size, here's what we're looking at, okay? We're looking at per pip. So if you have a 0.01, 0.10, or 1.0, let's just use flat rates. 0.01 does not equal 1 penny because remember, our pips are the fourth number after the decimal, not the first, not the second. So this is actually worth 10 cents. Now, when you move that over one place, this is actually worth $1, okay? And this looks like $1, but it's actually worth $10. And so don't make the mistake like I did in the beginning, thinking you were trading a penny, but you're actually trading 10 cents, or even worse, thinking you're trading 10 cents, but you're actually trading $1, or even worse, thinking you're trading $1, but you're actually trading $10 per pip. A mistake like this can blow your account. If you go in there thinking you're trading $1 per pip, but you lose 10 pips, you're gonna end up losing $100. So if you only have a $200 or $500 account, you just blew a lot of your account on one trade. It's very important that you understand this. Lot size, 0.01, 10 cents. 0.10, $1. 1.0, $10. And that goes the same for everything. So if this number goes up 1, it's changing by 10 cents every time. So if that's 0.02, how much is that? That's 20 cents. 0.03, 30 cents. 0.04, 40 cents. If this is the number that's changing, 0.20, that's $2. 0.03, $3. 0.4, $4. And if this one is changing, then you're going up by $10 each time. So essentially, if this is 2.0, you're using a $20 lot size. So very important that you figure that out because you don't want to make a mistake and trade with a higher risk than what you anticipated. So why is that important? Because the next thing we have to talk about is percentage-based risk. So we're looking at trading percentage-based risk. We don't want to trade flat lot sizes. So again, the same way that I hear people say that no matter what, I'm going to use a 0.01. I hear, especially beginners, I hear people say, when you're in the beginning of your trading career, you should only be trading 0.01 lot size. Well, you know, that's good because I guess you're not risking a lot. But the truth is that that's not necessary. What you really want to do is you want to have a percentage-based risk. And it's very easy to figure out. People just don't take the time to do it. First thing you have to understand is how much is in your account. So for this purpose, we're going to act like we have $1,000 in an account. So let's say you have $1,000 in your account. If you want to trade 1% of that account, here's what you got to do. Number one is you just simply divide by 100, and that will give you your total account, your total risk. So that's the long way to do it. That's the long way to do it. That's real easy, guys. Come on. $1,000. Don't be lazy. Just sit there and figure it out. Look at how much money you have in your account. Divide it by 100 and use that as your risk. It's not that hard. I'll even give you a quicker way. Look at your account size and move the decimal over 2 places. That's it. That's your account risk. You don't want to risk more than 1% in your account because if you risk more than that, you have the possibility of losing a lot of money. So in a $1,000 account, we're going to risk $10 in every trade. Now, if that's a $2,000 account, it's $20, $3,000, $30, $4,000, right? You get the point here. That shows you the power of compounding an account because once you get that account up to $100,000, $200,000, now suddenly that's $1,000, $2,000, and we're going to use what's called a risk to reward, which is another video for another time, but I use a 1 to 2 risk reward, meaning that if I'm risking $1,000, then my minimum reward is $2,000. So that means if I'm risking $1,000, my minimum gain is $2,000. If you're risking 10, your minimum gain should be 20. You should be having a minimum of a 1 to 2 risk reward, and we'll do some more content on that later. So the next thing we need to figure out is now that you know how much of 1%, how much is 1% of your account worth. So let's use the same basis. We have $1,000 account, and so we're gonna base our risk at $10. Okay, so 1% of our account is $10. So how do we know what our lot size should be at $10 risk? Well, here's the thing. We have to know some market structure, which again, we'll talk about later. What I want you to do is every single trade, I want you to figure out how many pips is my stop loss. So you can't just use a flat stop loss. Again, the same way we don't use a flat lot size, we don't use a flat stop loss either. I've heard people say, well, I'm just going to use 20 pips no matter what. My stop loss is always going to be 20 pips. Well, that doesn't make sense, because what if the trade, especially for long-term trades, calls for a larger stop loss? You're going to get stopped out because you didn't take the time to figure out what your stop loss should be. What if it's a scalp that only requires 5 pips for a stop loss? So now you're risking 20 pips for no reason. You didn't have to risk all that. So let's say it moves up and then moves back down or something, stops you out at 20 pips when it could have been a small 5 pip loss. I want you to go and figure out your stop loss in every single trade, because that's going to help you to understand how much you should be risking per pip. So now that you know how many pips is in your stop loss, we're going to base that off a 10 pip stop loss. So if you have $10 in your account, because that's 1% of 1,000, and you have a 10 pip stop loss, okay? So here's what we do. How do we know how much each pip is worth? Well, that's simple. If 10 pips equals $10, it's real simple. 10 divided by 10 equals $1. So in this case, you would be using a $1 lot size, because if you put in a $1 lot size with a 10 pip stop loss, your total risk would be $10. Now remember, you have to cover a spread, you have to cover a broker fee. Spreads should be probably somewhere around 1 pip, okay? So when you see, like when you're looking at the broker and it says something like spread, and next to it, it might say, 10, or it might say 28, something like that. What you're going to want to do is move that decimal over 1. So that means 1 pip, 2.8 pips, 14, 1.4 pips. So when you see a spread, that's how many pips the spread is, right? So 1 pip, 2.8 pips, 1.4 pips. If you're scalping, you really don't want a spread more than 2 pips, because now you have to understand you have to cover that spread before you can get into profit. So warning, you're going to get into a trade. Let me tell you what happens every time. New people come in, they put in a trade, maybe it's a demo account, and they come in and they say, man, I did everything I was supposed to, and as soon as I press buy, I was in the red immediately. Well, here's what's happening. The banks are going to take their money first, right? So when you go into a trade, let's say that there's a broker fee of $1.50, and there's a 1 pip spread, and you're at $1 lot size. So immediately, the broker is going to take their fee, and the spread has to be covered before you can get into profit. So 1 pip is worth $1, and you have a $1.50 broker fee. So you're going to end up with a $2.50 negative right from the beginning. So you're going to have to cover $2.50 before you even get into profit. So at $1 a pip, you need to account for that, because you're going to have to go into 2.5 pips of profit before, in the blue, before you even see a profit on your broker account. I hope that makes sense. Now, so why is all this important? Because when you're using a 1% risk, I want you to think about it this way. If you have a 1% risk and you lose 10 trades in a row, now that sounds like a lot of trades, and I hope you don't lose 10 trades in a row, but even if you do, you've only lost 10% of your account plus fees and commissions. So the likelihood is that you probably only lost about 13 or 14% of your account, losing 10 straight trades. Now imagine if you had that turned up to 10% each time. If you lost 10 in a row, you blew your account. All of your money's gone. That's why it's so important that we risk 1%, 1%, 1%. Let me put that in there. 1%. 1%. I know I said that a lot of times. Pop it on the screen. 1%. Because here's what you need to understand. I don't want you to blow your account. Now, with fees and commissions, you're probably going to have to lose about 70 straight trades in order to blow your account. If you lose 70 times in a row, I have to stop and tell you, Forex might not be for you. You can't lose 70 trades in a row. You know, if you lose 70 in a row, guys, I need you to just come and book a one-on-one, do something, you know, but you can't lose 70 in a row.